Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ast Spacemobile Inc. Annual Report. Ast Spacemobile Inc. offers a range of businesses and services that cater to various needs. At its core, the company designs and develops a constellation of Bluebird satellites in the United States. This satellite network enables cellular broadband services to be accessible directly by smartphones for both commercial use and government applications. The company's primary service is Spacemobile, which provides cellular broadband connectivity to users who are out of terrestrial coverage. This means that individuals can stay connected even when they are in remote areas or traveling abroad. By providing this service, Ast Spacemobile aims to bridge the gap between rural and urban areas, ensuring equal access to communication services for all. In addition to its core service, the company also offers a range of other applications and uses for its satellite network. These include commercial use, government use, and potentially even emergency response services. By providing a reliable and accessible means of communication, Ast Spacemobile is poised to revolutionize the way we stay connected in the modern world. The list of businesses and services provided by Ast Spacemobile includes design and development of Bluebird Satellite's cellular broadband network in space for commercial use, cellular broadband network in space for government use, Spacemobile service for out-of-coverage areas, commercial applications, government applications, potential emergency response services. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what could cause a stock price to skyrocket. The stock price of Ast Spacemobile Inc. has seen a significant surge in the past year, leaving investors and analysts eager to understand the underlying reasons behind this trend. One possible explanation is the company's innovative approach to space technology, which has captured the attention of industry experts and investors alike. Ast Spacemobile Inc. may have made groundbreaking discoveries or developed cutting-edge products that have revolutionized the field of space exploration. This could include advancements in propulsion systems, life support technologies, or even breakthroughs in space-based renewable energy sources. Such innovations often attract significant investment and attention from major players in the industry. Another possible factor contributing to the stock price increase is the company's strategic partnerships with other leading companies in the space sector. Collaborations of this nature can provide access to new markets, expertise, and resources, further solidifying Ast Spacemobile Inc.'s position as a leader in its field. Additionally, the growing demand for space-based services and technologies may also be driving up the stock price. As governments and private companies increasingly turn to space exploration and development, Ast Spacemobile Inc. could be well-positioned to capitalize on this trend. Lastly, it is possible that the company's financial performance has improved significantly in recent times, with increased revenue, profitability, or a strong cash flow position. This can create a positive feedback loop, where investors become more confident in the stock, driving up its price even further. In conclusion, the surge in Ast Spacemobile Inc.'s stock price is likely due to a combination of factors, including innovative technologies, strategic partnerships, growing demand for space-based services, and improved financial performance. Ast Spacemobile Inc. market capitalization of $40 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that Ast Spacemobile Inc. holds a significant advantage in their industry. Ast Spacemobile Inc. trades at a higher price-to-book ratio of 16.26 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 30% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in the wireless communications industry are multifaceted. On the growth side, partnerships with major mobile network operators, MNOs, and a revenue-sharing business model have been instrumental in driving revenue expansion. The launch of Block 1BB satellites and successful testing and deployment have also contributed to revenue growth. Additionally, the completion of performance obligations with the U.S. government and securing additional contracts have provided a significant boost. Furthermore, the sale of gateway equipment, software, and related services to MNOs has been a key driver of revenue growth. Initiating the Spacemobile service in targeted geographical markets and launching Block 2BB satellites have also increased capacity and expanded market reach. Securing additional contracts with the U.S. government or its prime contractors for non-commercial use of BB satellites has further contributed to revenue growth. On the decline side, failure to launch satellites or operate them successfully, competition from companies in the wireless communications industry, and increasing competition from land-based communication services or new technologies have all been significant drivers of revenue decline. Launch failures and satellite operational problems, intermittent signal disruptions and dropped connections, and failure to provide an acceptable level of service have also contributed to revenue decline. In conclusion, the success of a company in the wireless communications industry depends on its ability to navigate these complex drivers of revenue growth and decline. By understanding and addressing these factors, companies can position themselves for long-term success and growth. Net income has experienced a decline over the past year. In 2024, it stood at $300,083, but by 2025, it had decreased to $341,940, indicating an increase in losses. The cumulative net loss from inception through December 31, 2025 was approximately $831.7 million. The reasons behind this decline are attributed to two key factors. Firstly, the inclusion of penny warrants in the calculation of basic and diluted net loss per share from June 23, 2025 contributed to the worsening losses. Secondly, the exclusion of shares that would have reduced the net loss per share further exacerbated the situation. These changes had a significant impact on the company's financial performance, leading to increased losses over time. Based on the extracted summaries, it appears that the company is struggling to generate sufficient cash from its operations. According to the financial statements, the net cash used in operating activities for 2025 was a significant $71,517. This indicates that the company's expenses are exceeding its revenues, resulting in a substantial outflow of cash. Furthermore, the company's own conclusion reinforces this finding, stating explicitly that the company is not generating positive operating cash flow. This suggests that the issue is not just a temporary blip, but rather a persistent problem that requires attention and action to address. Overall, these findings suggest that the company is facing significant challenges in generating positive operating cash flow. The company's debt level has undergone significant changes between 2024 and 2025. Total debt increased from $285,415 in 2024 to $2,622,062 in 2025, a substantial rise of over $2 million. Long-term debt also saw a notable increase, rising from $155,573 in 2024 to $2,207,583 in 2025. The company issued convertible senior notes worth $575 million and $1 billion, further contributing to the surge in total debt. Interest expenses have also seen a significant change, with an overall increase of over $17,000, 93%, from 2024 to 2025. Interest expense rose from $18,681 in 2024 to $36,071 in 2025, while interest expense decreased from $2,959 in 2024 to $1,361 in 2025, is an outlier and not representative of the overall trend. The company recognized a one-time amortization of commitment fee within interest expense in 2025, adding $4 million to the total. The substantial increase in both debt levels and interest expenses from 2024 to 2025 indicates that the company has taken on significant new debt obligations, resulting in higher interest expenses. The performance of various regions and segments in the market has been a subject of interest. On the positive side, the United States has shown significant growth due to its commercial agreements with major players such as AT&T and Verizon. Similarly, international markets outside the U.S. have also performed well, thanks to partnerships with prominent companies like Vodafone and STC. However, there are some regions that may be affected by market trends. India, Scotland, Spain, and Israel are among those that could face challenges in the coming period. These countries' performance is expected to be impacted due to various factors, although specific details are not provided. The management's outlook on the company's strategy and future prospects is optimistic, with a focus on innovation and expansion. The company plans to build the first global cellular broadband network in space, accessible directly by everyday smartphones, through a revenue-sharing business model with mobile network operators, MNOs. This ambitious project involves launching and operating approximately 90 low Earth orbit satellites to achieve non-continuous spacemobile service in targeted markets and continuous coverage across key markets. The company's financial projections indicate that it has sufficient cash reserves to meet its anticipated needs for the next 12 months, thanks to significant prepayments from major partners such as STC and Verizon. However, management acknowledges potential risks, including geopolitical events, higher interest rates, and inflationary economic conditions, which could impact their ability to raise necessary financing. To mitigate these risks, the company plans to finance its cash needs through a combination of equity issuance, debt securities, loans, or credit from government or financial institutions until it can generate substantial revenues. The closing of the spectrum usage rights transaction is still subject to receipt of satisfactory regulatory approvals, which will be crucial for the success of their ambitious project. Overall, management's strategy and outlook emphasize innovation, expansion, and risk management, with a focus on building a sustainable business model that leverages cutting-edge technology and strategic partnerships. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the most notable include the Ligado transaction, which granted rights to use Ligado's assets, including satellites and spectrum usage rights. The company also acquired subleased spectrum amounts through a sublease with Crown Castle Holding LLC. Additionally, it secured long-term access to up to 45 MHz of lower mid-band spectrum in the United States and Canada for $550 million contingent payment through the spectrum usage rights transaction. Furthermore, the global S-band spectrum priority rights acquisition was made for $64.5 million. The company has also engaged in several divestitures, including the sale of Class A common stock under various equity distribution agreements. These agreements resulted in significant revenue, with sales totaling $74.8 million, $488.7 million, and $706.3 million in 2024, May 2025, and October 2025 respectively. The company's acquisition and divestiture activities demonstrate its strategic efforts to optimize its assets and resources. In reviewing the financial activities of the company, it is clear that they have engaged in two key practices: paying dividends to shareholders and buying back shares. The company has a history of paying dividends, as noted on page 38 of their financial reports. This indicates a commitment to returning value to their investors through regular distributions of profits. In addition to paying dividends, the company has also been active in buying back shares. Specifically, they have repurchased $502.9 million, $346.9 million, and $161.1 million worth of 2032 4.25% convertible notes, as stated on page 60. This demonstrates a strategic effort to reduce their outstanding share count and potentially boost earnings per share for remaining investors. Overall, these actions suggest that the company is focused on creating value for its shareholders through both dividend payments and share repurchases. That concludes the financial summary for Ast Spacemobile Inc. Feel free to comment below, and I will be happy to answer them when possible.